I am excited to launch something new, something exciting, and something that I hope you will find quite helpful. And that is our Alternatives Decoded chart book, which is designed to be a chart driven narrative to really help you navigate the world of alternative investments. So it is a chart book, but I would also say it is so much more. We've actually designed a website that you can visit on the iCapital.com webpage under the Learn tab. You could explore the insights within private equity and hedge funds and structured investments. I decided to use some of the slides from Alternatives Decoded today to really kind of reinforce some of the messages and conversations that you heard at the conference today. So let's start with private equity. Why might you want to consider it? Well, because the public markets have been shrinking. And if you look at this chart, you'll see that since 2000, fewer companies went public as they stayed private for longer, which means that the universe of public companies is shrinking while the universe of private companies is actually rising quite significantly. So you can see, for example, just in the United States, there's about 11,000 or so private companies. Compare that to 4,600 publicly listed companies. So private companies, private equity backed companies have managed to outgrow publicly traded one in terms of profitability and also profitability margins. So that is the key right here to creating value in private equity. There's been a lot of conversation about private credit. There's been some concerns, but the story of private credit is a solid one and is still very much ongoing. There's this conversation about the secular shift towards private credit. And why is that? Well, take a look at this chart right here. This shows you the share of banks in lending to middle market companies versus the share of non-banks. And in the year of 1994, you had about 75% of lending to middle market companies that was done by banks. You fast forward to today, and about 25% of lending occurs from the banking sector. The rest of it, 75%, is actually done by non banks. The rise in private credit is moving in lockstep with a rise in private equity. But let's take a look at some of the returns and yields that are also possible in private credit today relative to what else you might get in public markets. And for example, looking at the yields in private credit today are still somewhere around 12% because 85% or more of private credit is floating rate and the rates are still fairly elevated. 12% compares quite favorably to leveraged loans, which pull back to about 9%, and high yields are about 7% today. So certainly that uptick in yield in private credit is the reason for investors to look at this asset class. All right, let's talk about real estate. So I'm going to share with you a couple of charts that really tell that narrative. So first of all, commercial real estate, if you've not looked at the asset class, it's an important one. It's a sizable one. In the United States alone, $21 trillion, that's the value that is represented by physical commercial real estate. And it is multifamily, it is office, it is retail, it is specialty, it is industrial, it is healthcare. It is quite a few sectors. And I know that one of the concerns, I'm sure that might have been on your minds is, well, real estate isn't all about office. Well, 3.2 trillion of the 21 trillion is office. So that's about 15%. And yes, there's concerns about that, but most of commercial real estate is actually located in sectors that have quite solid fundamentals. So an important asset class from the size perspective. And so, for example, on the right-hand side, you see the real estate funds under management have grown consistently, and they're still expected to go from $1.6 trillion today to $2.7 by 2029. So what is there to be optimistic about within commercial real estate? Well, I think a few things. First of all, the entry point, and the second of all, the solid fundamentals. So if you look at the entry point in commercial real estate, on the left part of the slide, you see the year-over-year change in commercial real estate prices. And at some point, it's true that year-over-year, prices were down about close to 20% for the overall commercial real estate index. So one of the factors that matters for real estate is net operating income growth. Why do you invest in real estate? You expect stability of income, but you also expect appreciation of that income stream to at least keep up with inflation. So if you look at NOI growth today, It's not running at 9% like it was right after the pandemic, but it's still running about 3.5%. And that is a very solid number because in the US, at least, core PC inflation has now slowed to 2.6%. Now, some sectors are doing better than others. But if you look all the way over to the right, you'll find industrial real estate, healthcare, for example, are seeing those growth rates that are well above their 10-year averages. And that's why a lot of the managers we work with certainly focus on that space. So, this was just a taste of some of the key messages and takeaways that you saw in private equity, private credit, and real estate. We really sincerely hope that this can be a useful resource to you and a one-stop destination and a comprehensive overview for all things alternatives and can help you stay well informed and certainly well ahead.